Good morning. So for today's discussion, we will be having an overview of financial management. So in this module, we begin by describing how finance is related to the overall business environment. At the end of this module, you should be able to explain the role of finance and the different jobs of finance. Also, you should be able to identify the advantages and disadvantages of different forms of business organization. Okay, so what is finance? So finance has a lot of definition to define with, but for some, it is management of large amounts of money by the government or large companies. So basically, when we think about finance, the first thing that would come out in our minds or the first image that would come out in our minds is the image of a money. Okay. Next, it is a money management and the process of acquiring funds. So in a business, there's really a need to acquire new funds for expansion or let's say for new acquisitions of assets. Okay. So next is finance also is a study of money, banking, credit, investment, assets, and liabilities that makes up the financial system. So it's not only about acquiring funds, but it is also about the credit terms, the investments, and the banking sector. Okay, so to sum it up, according to the Webster's Dictionary, finance is defined as a system that includes the circulation of money, okay, the granting of credit, okay, so here, the making of investment, and the provision of banking facilities. Okay, so for the forms of business organization, we have four types. Okay, so first off, we have here the sole proprietorship. Second is a partnership. Third is the corporation. Now, in the corporation, we have three kinds of corporation: the S corporation, the limited liability company, and the one-person corporation. Fourth one is the cooperative. So for the succeeding slides, I will be discussing to you each forms of business organization. Okay, so for the first form of business organization, we have here the sole proprietorship. Okay, so sole proprietorship is considered as the simplest form and the most common form of business ownership. Now, it is because the business is owned and run by an individual for their own benefit. So from the word itself, from the word itself, sole meaning one. So again, it is run by one person for their own benefit. The business existence is entirely dependent on the owner's decision. So when the owner dies, so does the business. And sole proprietorship is considered the most popular form of business ownership because, again, as what I've said, it is the simplest form and the easiest way to build up your own business. Okay, so for the next form of business organization, we have here the partnership. So unlike the sole proprietorship, partnership is an association of two or more persons to act as a co-owner of a business for profit. So again, unlike with the sole proprietorship that it has only one person or one owner, for partnership it could have a two or more person as an owner of the business. So there is no legal limit on the maximum numbers of partner, but most business with a partnership form has or have only two owners. And then the firm's income is usually allocated on a prorated basis. Now, how does it work? Um, when both partners or when the both owners invested a equal capital in their business, they will be having a equal allocation that is 50-50 of their profit sharing. Now, another example, if partner A invested 60,000 in their business and partner B invested only 40,000 on their business, so Basically, the allocation of their profit should be 60-40. 60% for the partner A and 40% for partner B. So that is how the prorated basis works. Okay, for the types of partnership, we have here the limited partner and the general partner. Now, for the both types, uh, both partners own a part of the company and then they also receive the share of profit. But here in the general partner, it oversees the company and it is also the person responsible for the daily operations. And also it has the decision making rights. Now, um, the general partner has also the full liability for all the decisions he has made for the business. While the limited partner, uh, the difference between the limited partnership and the general partnership is that limited partnership are more structured than general partnership and should have both general and limited partners. Okay, so when a business starts to have a limited partnership, it should have both the general and limited partners. Okay, so a limited partner is well limited, so it only serves as investors. So that's the key point there. The limited partners serves as investors for the partnership. And typically, a limited partner does not have the decision-making rights, but they get the ownership, okay? But they don't have as many risks and responsibility as the general partner. Okay, so for the third form of business organization, we have here the corporation. Now, a corporation is a legal entity and it is separate from its owner. So, unlike with the sole proprietorship, where if the business owner dies, the business will also die. Now, here in the corporation, when a business owner dies, the corporation will still exist, okay? Because again, it is a legal entity. Most common type of corporation is known as the C corporation. Now, corporation is owned by stockholders, and articles of incorporation must be filed and corporate bylaws should be adopted. Owners are not personally liable for the debts of the corporation. So, unlike sole proprietorship, that when the business has liabilities, okay, the creditor could run after the business owners. Now, here for the corporation, the creditors will only run for the corporation itself, but again, because it is a legal entity. Okay, so corporation, it is not a separate taxable entity. Taxes are filed through owner's personal tax return, and then capital is raised through sale of stock and debt issues. So, for the corporation to raise funds, they are issuing shares of stocks or common stocks or in a form of debt, or it is also known as bonds. Okay? Okay, so these are an example of a corporation, large corporation here in the Philippines. Okay, so most of them are blue chip companies that are listed in the PSE stock exchange. Okay, so we also have special elements of corporation. First off, we have stock. So stock, it is a share of ownership of a corporation. So we have here two types of stocks, the common stock and the preferred stock. The common stock has the voting rights or the voting privileges, while the preferred stock has no voting rights. But when the company pays out dividends, the preferred stock will be preferred stockholders are being prioritized. Second, we have here the stockholder. Stockholder, it is a person who owns shares of a corporation stock. Next is dividend. A dividend is a portion of the corporation's profit that is distributed to its shareholder. Board of directors. It is the governing body of the corporation. And then We have here the closed corporation or the private corporation. These are the corporation whose stock is owned by relatively few people and is not sold to the general public. So basically, an example of this is a corporation that is owned by a family members only. So the shares that they have are not being sold to the public. Okay. We have also here the open corporation or the public corporation. So these are the corporation whose stock is bought and sold on security exchange and can be purchased by any individual. So these public corporations are also listed in the PSE stock exchange. So basically they can be traded and they can be bought in a security exchange. Okay, so we have here the S corporation. S corporation, it is a form of corporation that meets specific internal revenue code requirement. So the S corporation are restricted to no more than 100 shareholders. Okay, so for the difference between the C corporation and the S corporation, for the C corporation, it is being taxed as separate entity. And shareholders are not also taxed, and then the shareholders pay its income on payments from the corporation, and it is always recognized by the federal and state or by the government. While the S corporation, it avoids double taxation. The corporation doesn't pay the income taxes, and it could include losses on the personal taxes, and it is not recognized in certain states. Okay, we have also here one-person corporation. So a one-person corporation is a new type of corporation that was established last February 23, 2019, um, from the Republic Act 11232 or the Revised Corporation Code of the Philippines. Now, a one-person corporation is a corporation with only one stockholder and should be able to enjoy the rights and privileges that traditionally organized corporations are entitled to. So basically, a one person corporation is owned by only one stockholder. We also have here a form of business organization, which is the limited liability company. So a limited liability company, it is a hybrid form of business that have the characteristic of both a corporation and a partnership. Um, a limited liability company rather is not incorporated. So again, it is not considered as a corporation. But the owners enjoys limited liability like the corporation, and then the in this form of business, um an LLC or a limited liability company may elect to be taxed as a sole proprietorship, a partnership, or a corporation. Next, we have here the cooperative. A cooperative is a business organization owned by a group of individuals and is operated by or for their mutual benefit. Okay? So the person making up the group are called members. So members. Cooperatives may be incorporated or unincorporated. So these are the summary of the types or the forms of business organization, according to its ownership, the startup requirement, the taxes, the liability, and its termination. Okay, so let's proceed. So let's have finance within organization. So in an organization or in a business setup, or let's say in a corporation, we have here again the board of directors. So under the board of directors, we have the chief executive officer. Okay, the Chief Executive Officer oversees the entire business. Now, under the Chief Executive Officers, it has two Chief Officers, okay? The Chief Operating Officer and the Chief Financial Officer. The Chief Financial Officer or the COO oversees the marketing, the production, human resource, and other operating departments, while the Chief Financial Officer oversees the accounting, the treasury, the credit, the legal, capital budgeting, and the investors relations. Now, there are three areas of finance. First is the financial management, the capital market, and the investment. So, for the succeeding slides, we will discuss each areas of. First is the financial management. Here, it focuses on the decisions relating to how much and what types of asset to acquire, how to raise the capital needed to purchase assets, and how to run the firm as to maximize its value. Okay, so for the capital market, it relates to the markets where interest rates along with the stock and bond prices are determined. So it also studies the financial institutions that supplies capital to business. Okay, for investment, it relates to the decision concerning stocks and bonds and includes a number of activities. Okay, so similar with the capital market, it also relates with the decisions regarding the stocks and bonds. Now, the activities included in investment are the following. We have here the security analysis. The security analysis deals with the finding of proper values of individual security. In the portfolio theory, it deals with the best way to structure a portfolio. So, a portfolio, it is a pool of funds, okay, a pool of funds with different um, areas or different categories. So, market analysis, it deals with the issue of whether stock and bond markets are at any given time are too high, too low, or about time. Okay, so when you do market analysis, you think if um, the stock prices are already too high, or is it too low, or is it about time to sell or about time to buy a certain stock. Okay. Okay, so what do you think is the primary goal of the management? Is it profit maximization or wealth maximization? For profit maximization, it is a term which denotes the maximum profit to be earned by an organization in a given period of time. So this goals implies that the investment, financing, and dividend decisions of the enterprise should be oriented to profit maximization alone. Okay? While wealth maximization, it is when business managers try to maximize the wealth of their firm. So they are actually trying to increase the company's stock price. As the stock price increases, the value of the firm also increases. Okay? As the stock price increases, the value of the firm increases as well. So, as well as the shareholders' wealth. Okay. Now let's differentiate the two goals. Is it profit maximization or wealth maximization? For the profit maximization, its main objective is to earn large amount of profit. Okay? Large amount of profit alone. While for the wealth maximization, its main objective is to achieve the highest market value of the common stock. Okay? For profit maximization, it emphasizes only short-term investments, while the wealth maximization, it emphasizes long-term investments. For profit maximization, it ignores the time value of money. Okay? While in wealth maximization, it considers the time value of money. For profit maximization, it ignores the risks and uncertainties, while wealth maximization recognizes risk and uncertainties. Now, let's go to the intrinsic value. Intrinsic value, so it is an estimate of the stock's true value based on the accurate risk and return data. So basically, intrinsic value is the true value of a stock. Okay? So it can be estimated but not measured precisely. Okay? It can be estimated but not measured precisely. And then, in order for you to get the intrinsic value, you need to have or to do a fundamental analysis. So let's go with the equilibrium. So equilibrium, it is a situation in which the actual market price equals the intrinsic value. So the investors are indifferent between buying or selling a stock. So here in the graph, we can see that the broken line here is the intrinsic value. Okay? And the actual price or the actual stock price here is the solid line. Okay, the solid line. Now, when the intrinsic value is higher than the actual stock price, meaning to say the stocks being sold that at that time are undervalued. But if the actual stock price is higher than the intrinsic value, meaning to say that those stocks being sold at that time are overvalued. Okay? Okay, so that's it for the overview of the financial management, and I hope you learned something from our discussion. And for the next topic, we will be having the financial institution and market. So study in advance, and thank you, and God bless.